So when we think about will mortgage rates drop, I think it's first important to take a step back and just look at what is being predicted. And these predictions are coming from 17 different major research groups. So Resi Club, Fannie Mae, Freddie Mac, Mortgage Bankers Association, like it is just, everybody's got an opinion on this. And for the most part, they think that interest rates will land right around 6.5%. Could be a little bit higher, could be a little bit lower, but that's kind of the consensus, if you will, between all of these different organizations and their interpretations of the market. Now, this is really important to know because they often don't get it right. So, yes, it's one thing to hear what the predictions are, but there's so many different factors that drive the economy, that drive mortgage rates, that drive the Treasury yields. There's so much going on. Now that we're through the election, I think that that does now position people to kind of settle into whatever their thoughts are about a lot of different markets, but today we're talking about housing. And as we move through the coming months, there is one area that I think is important. You know, in the past I've said, look at what's happening with the yield on the 10-year Treasury, because it's very difficult to really track and understand mortgage-backed securities, which is really the instrument that drives long-term mortgage rates. But historically, there's a spread between the 10-year Treasury yield and mortgage-backed securities. And that's usually about 1.5% to 2%. But over the last couple of years, that spread has been significantly larger, meaning that if the 10-year Treasury was running 4.5%, which is about where it is today, you would add 3 points to that to get to where average mortgage rates are. So if we're adding 3 points to 4.5, that's putting us right around that 7.5% number. So the theory here is that as that spread between the 10-year Treasury and mortgage-backed securities starts to decrease, we will see interest rates prevail. So think about this. In 2019, the difference between the 10-year Treasury and mortgage-backed securities, or the rate at that point in time, was about 1%. 1%, think about it. So if, based on a 4.5% 10-year Treasury with 1%, that would put mortgage rates around 5.5% versus the prediction of 6.5%. Now, there's so many things that go into that. Why are mortgage rates so much higher? Why is that spread wider than it traditionally is? The reason it's wider is because of inflation, because of the strong economy that almost is like counteracting this inflation concern. When we think about long-term investments, inflation impacts the security instrument that investors purchase. So that's one reason, that's one element of why that interest rates are kind of like higher for longer and why we aren't really seeing interest rates come down. Now, what's going to be interesting is as the 10-year Treasury starts to come down, what we're looking for is, will mortgage rates start to come down? One piece of it. And two, will the spread between the 10-year Treasury and mortgage rates also start to come down? That's a double whammy. That's what we're hoping for. But if you ask me for my prediction, which I know y'all want to know, I really think we're probably going to end up in the high 5s, low 6s. And that would be fantastic, because once we get under that 6.5%, I mean, even at 6.5% versus, let's say, 7 or 7.5%, it's a big deal from an affordability standpoint. But once that rate eases into the low 6s, high 5s, all of that pent-up demand, it allows for people to now have a different conversation. And with that, though, the risk with that is that all this pent-up demand out there on the sidelines, waiting for interest rates to come down. Will they come down? We don't know. When will they come down? We don't know. Will they ever come down? We don't know. But all that pent-up demand is waiting. So if interest rates really do get to those low 6s, high 5s, my fear is that we're going to see all that competition come back into the market, which then leads to other challenges. So if you're in a position to qualify now and you can get a price negotiation or you can get seller credit towards the closing cost and you can afford the payment at today's interest rates, it's prudent to at least explore it. If you have questions about where you are positioned with regard to payments and price point and where in the country you want to buy, don't hesitate to reach out. This is what we do. 15-minute quick conversation. We kind of walk through it, give you some high-level numbers, and then that way you can decide, gosh, I want to beat the rush, or I'm going to wait it out and see if rates go down. If you want to beat that pent-up demand rush that we expect as interest rates come down, there are ways today that you can take advantage of different types of strategies, one of which is a buy down. So are you buying down the permanent interest rate? Another one is an adjustable rate. Are you looking at an adjustable rate that maybe has a fixed rate period on it? For example, many of the adjustable rate programs today are hybrid adjustable rates, which means it gives you a fixed rate for a period of time. That period of time could be 3-year fixed, 5-year fixed, 7-year fixed, 10-year fixed, and then thereafter it would adjust based on the index and the margin and the caps involved on that program. But there's also these temporary buy downs, and they've been around now for a while. In fact, they've been around for years, but they come and go based on the market. So in this particular market, they've been around for a while, and that temporary buy down looks like this. If you're negotiating with the seller and the seller agrees to contribute towards your closing cost, your lender can look at using that money to help you buy down your interest rate roughly 2 percentage points, sometimes 3, lower than whatever your note rate is. So for example, let's say that your interest rate is 7% today. And let's say that your real estate agent has negotiated the seller to contribute towards your closing cost, and there's enough funds there to be able to buy down that interest rate on a temporary buy down. On a 2-1 buy down, it means that your start rate, your payment for the first year, is going to be 2 percentage points lower than whatever your actual note rate is. So in this example, it would be a payment based on 5% interest rate for the first 12 months. The second 12 months, your interest rate would increase to 6%. So your payment is based on 6% for the next 12 months. And then the third and final year in this scenario, your rate would be whatever that note rate is, which is that 7% interest rate. The advantage of this type of strategy is that it gives people that runway into affordability, and it also allows for them to kind of not have to wait it out and see if rates drop. The disadvantage of this type of strategy is that what if rates don't drop? And you are banking on rates dropping, and you're setting your budget based on that first year payment or second year payment. And then you adjust to the third year, and maybe you're in a position now that you can't afford the house. So we really do a lot of consultation when we're talking with people about the temporary buy down strategy. We use it often, but it's just important to understand how it works and that your budget fits around whatever that note rate is in that scenario. But I really do like these permanent buy down scenarios as well. So on a permanent buy down, same situation, maybe you have that seller contributing towards your closing cost in addition to whatever funds that you want to contribute to buying down the interest rate, and then the lender will use those funds to buy down that permanent note rate without any type of adjustment. All different types of strategy here, and it's truly based on whatever your personal goals are, what's going on in your household budget, and what's going on in your future. Maybe you just graduated from college. Maybe you're getting your first job. Maybe you are getting ready to take another job that you know pays more or has some type of bonus or commission income, and so you're comfortable with that temporary buy down strategy. Lots that goes into it. If you have questions and you just want to chat through your particular scenario, we're here for you. 480-725-0150.